Welcome to TheoTrade. This is Don Kaufman. It's February 10th, 2018. Where to begin in discussions of this market from the previous week? Well, first of all, it's one of the most epic volatility weeks that we've seen in a number of years. And I want to get into some very detailed specifics about some of the trade action that we saw this past week. However, I'm much more concerned about positioning yourself moving forward and asking yourself that question. Are you really comfortable with whatever risk you happen to have on? Some incredibly large opportunities are going to start to present themselves in this marketplace. First of all, we're going to have to be relatively constrained. We're going to have to be relatively patient. You know, the one thing, the moment that volatility hits, people get excited, they're ready to come in there, they're ready to buy the dip. But you really have to step back and again, kind of gain some perspective. How many years in a row has this marketplace rallied? And I'm not coming to you and I'm not saying, you know, from a bearish standpoint. Just take a look at any 5-year chart, 10-year chart, if you will, on any major indice, okay? Whether it's a weekly, whether it's a monthly, it doesn't matter. At this point in time, again, I want you to be forward-looking. We'll talk about last week a little bit when we get into the charts here in a few minutes. But for right now, I want to be forward-looking. And you'll see that, you know, markets, sure, they made a little bit of a dent. And, you know, we had a 4% plus down day in the Dow. And it feels like the end of the world. And I have to tell you, I mean, quite honestly, I'm exhausted at the end of a volatile week like this. But again, first and foremost, you really have to be able to understand, to comprehend your risk is huge. If you have your risk currently under control, whatever that is, whether you're long, whether you're short, whether you've sold some premium, whether you've bought some premium, you better know in this marketplace, dollar for dollar, what you can make and what you can lose. Because it's only those that have a handle on their present risk that can actually function in future volatility. And I say without unequivocation, that is what's coming. We cracked wide open in terms of volatility. I mean, you have seen funds that have been around for years that were short volatility that are no longer. So again, you have to understand that risk. Everybody, I think, has to take some time, whether it's this weekend, sometime next week, and look at the 401k statements. I mean, it's okay. I know that none of your fund managers want you to do that. Take a look at it. We all have 401ks and IRAs, including myself. You know, do you have some long stock positions and you didn't take like a deep look as to whether you want to continue to hold some of those positions moving forward? Recognize right now, it doesn't matter what any market pundit is going to say. Again, you know, you're going to have people that are, you know, this is the greatest buying opportunity of all time, right? Or you're going to have people say, that's it, it's the end of an era. I'll give you a little bit of my opinion, but in the end, you got to sit there by your lonesome, okay, and figure out what risk is going to be right for you. It doesn't matter if you've sustained gains for years. You don't want to sit there and give it all back. I mean, we stared down the face earlier this week, okay, of a hideous move in the marketplace. You saw follow through later in the week, another 1,000-point plus down day in the Dow. But at the same time, you got to realize, again, it's what counts moving forward, okay? And a lot in the environment has changed. So there was one other statement I made on the last weekend update, and I'll bring that back up. And last weekend I talked about, you know, volatility not even really catching its stride. Well, here we are, right? And we've seen volatility. And there was an exact phrase I used. I go, you know, we haven't even felt the fear yet. Well, now a lot of you that are a little newer to this business know precisely what feel the fear kind of means. Moving forward, we are going to continue to look at bonds and we will continue to look at financials. But there's one thing that you have to kind of recognize, and that's this. In the previous 10 years, really since the financial crisis, the Fed, the Federal Reserve, they have had your back, right? Lowering interest rates, feeding us ultimately with what? Liquidity out there. It's ultimately get the economy moving really at any cost, and they flooded us with ultimately low interest rate products. The Fed's no longer with us. The Fed now has shifted, okay? And what is really causing a lot of the volatility is that the market recognizes this. The Fed doesn't have your back, okay? The Fed is wind in your face right now. We are raising interest rates. And the volatility that kicked off this week, there was an irony I talked about earlier in the week, and that was Jerome Powell was literally being sworn in as the new chairperson for the Fed, while the Dow was down 1,400 points. Okay? It's a message that, again, to the Fed, it's a message to all central bankers. Now, it wouldn't surprise me if volatility kind of continues this next week. It wouldn't surprise me for a second to see somebody like Mario Draghi or the Bank of Japan step in and try to do something about it. Jerome Powell here, he's not going to say a word, doesn't have the credibility yet. Nobody even knows who this guy is, right? We are still, again, staring down the face of some serious volatility. As I said, you kind of have to take this, this introspective look and what kind of positions do you really want to hold in this? On the flip side of that, some of the greatest opportunities that you're ever going to get, premium selling is so very, very back. You're going to see an expected move this next week. The S&Ps, their range this next week is expected to be about $130. I mean, this is Mr. Toad's wild ride kind of a marketplace. And that, people, is what's advantageous. Control your risk that you have on now, because I'm telling you, the future holds incredible opportunities. Now, let's get over to some of the charts. All right, so let's get started with looking at a couple of charts. We're first going to kind of zoom into the SPX. So many of you know I track what's termed expected move. That is the expected price action based on the forward options. On a week-to-week basis, we've been looking at expected moves now for years. And one of the things I've been talking about extensively in some of the recent videos is a move in a marketplace, and the entire marketplace, from a period of what we'll term efficiency to this incredible inefficiency. And what I really want to elaborate upon right now is why this is going to be able to create some opportunities. So if you take a look at what I might term, again, the expected moves in efficiency and inefficiency, you have ultimately, here's 1, 2, 3, 4, 5 breaches of expected move at the end of the week in the most recent 6 weeks of trading. So again, this means for the time being, okay, you can sell some options premium. It's probably going to have to be a little bit further out in time. And that's something we've actually been doing in the TheoTrade chat room on a day-to-day basis, is kind of discussing what your duration should be. But the point to be made with this, so all right, 5 of the last 6 times we actually breached through expected move. I mean, yesterday's breach was fairly wild to the downside. Nevertheless, we did retract back up to a degree. But what you have to recognize about these breaches of expected move, and again, all directional bias aside, doesn't matter what you think right now, don't care whether you're bullish or bearish, we'll come back to that in a moment, but all directional bias aside, what this means is we're going to see, okay, a continued expansion of volatility, okay, specific, and this is specific to the S&P 500 or the SPX. When I say there's going to be a continued expansion of volatility, like, people don't really necessarily get it. Well, I want to make that really clear for you. So if I were to look out to this coming week, all right, in the coming week, and I look at, I could look at the Monday and the Wednesday, and there's actually 2 Friday expirations. I'm looking at the Friday PM expiration. The expected move here is just shy of about $100. Okay, it actually was as high as 145 on Friday during some of the trade. It backed off just a little bit, but the expected move is just shy of $100. The point that I'm making is right now, all of the expected moves, even then when they've expanded, have still been breached. So we're going to get this continued expansion of volatility, and well, hopefully the implied volatility will continually exceed the actual price movement. And that provides this incredible opportunity for those of you that want to be able to sell premium. And again, I'm just going to kind of lay this out for you real quick, because this is the stuff that makes people money in this business. You know, everybody's like, well, are we going up or we're going down? Well, first, you know, when I say we want to make some money in the business, you have to look at a distribution curve and say, all right, this would be, let's say, the expected move. All right, that's the EM, that's the expected move. And it's still being breached. Here's the marketplace, and it's ripping through the expected move to the downside. It has the propensity to explode back to the upside, but it's not staying in what is expected. So what happens, and we'll actually see this in the next couple of weeks, you'll actually see the volatilities in the short duration kind of continue to either expand out, or we're going to see a contraction of actual price movement. But for the next and foreseeable future, what will happen here is that the option pricing, which are the expected moves, will widen out. And the option pricing will often exceed the actual price movement. And again, therein lies like the edge, if you will, for premium selling. And it is going to be so very, very back. And I'd like to start with that, because premium sellers, listen, you got to think, it's not the time just to go out there and blindly fire into the marketplace. You know, in watching this, the volatility has expanded. We're on the largest expected move that we've seen since we've been tracking expected moves right now. You know, $100. It's a $100 move in what? A 5-day window in the S&P. Now it's going to start to become very advantageous for some premium sellers. All right. Along with that, I do want to point out one thing that's a little bit, to me at least, kind of intimidating, and that has to do with the VVIX. Now, we're going to go through a lot of stuff. We're going to look at a couple of individual stocks here in a moment as well, and some opportunities in here and now. But for those of you, if you've never looked at the VVIX, it's the volatility of the Volatility Index. And again, I've been watching this since its inception, but I want you to look back just over like the last 5 years with me. This is just a 5-year daily. Since the VVIX was created, and again, it's the volatility of the VIX itself. So if the volatility of the VIX is high, what does it say? It says we're in store for like a really, really wild ride, specifically in the VIX. The VIX is going to be flying all over the place. Now, this happened to be August of 2015, right? In August of 2015, it was serious. We were down like 7% in one day. But this is kind of what I call a flash in the pan, right? We shot to 200, contracted almost immediately, and we're right back down on the 110 handle, okay? If you take a look in contrast, we just shot up, and we're up there, and we're staying elevated in the VVIX. And I have to tell you, from where I sit, what this again means, if you take a look specifically at the VIX and forget about the chart, just go to the option chain on the VIX. I mean, this is intimidating. The volatility of the options in the VIX are just massive premium in there. Incredible display to me of hedging activity from professional firms. They're running scared. This has never maintained anywhere near the elevation for this number of days. That does lead me to believe that we're nowhere near or through a period of volatility right now. I mean, we want to see this contract, and you know, not just the VIX, but you really want to see the VVIX, okay, contract and do it substantially. When the VVIX, you know, is elevated, I would have expectations it would have come back down already to like 120 and kind of cooled off. Again, to point out, the last time we got any real volatility in the marketplace was coming back into 2016, in early 2016. And again, I'll kind of highlight this. You can see this is when the marketplace had kind of sold off down to about 1,800 on the S&Ps, and this is early 2016. The VIX got right up into the 30 handle. Just to point out the exact same time frame in the VVIX. All right, let's go back to the same time frame in the VVIX and take a look. The VVIX at that point only got to like 120. And again, it's very, I think, disconcerting. I mean, the VVIX spiked obviously back here. Again, that was August of 2015. But the volatility of the volatility products, all right, is in never, never land. And to see it even move down, we had a nice size rally in the close of Friday to move down like 7%. It's still not enough. That needs to come down substantially in some of the days to come. Now, I'm going to switch gears completely here. And I want to look, as I was talking about a couple of moments ago, I want to look at some individual stocks. And I said, bring up like any 5-year chart. So I'm going to start with the spiders just to make a quick point over here. And I'm going to switch this over to like a weekly. Here's the spiders over the last 5 years on a weekly. Okay. Now, that becomes, again, it's a little bit intimidating, right? All right, we've seen some down move. We bounced a little bit over here. But how much damage has really occurred? All right. I mean, here we currently are. Look, we're just back to where we were, what, 2 months ago? I mean, please, that's the perspective that I wanted to give you for just a moment. You know, I don't care if you're a market technician. I don't care, like, is there going to be downside? Is there going to be upside over here? Listen, it's kind of intimidating to look at that. And now, more specifically, I want to give you individual underlyings that I think you need to keep a very, very close eye on. I'm actually going to go to a year-to-date percentage. So if you're not aware, the spiders are now down about, 2.7% year-to-date. But I want to look at some individual components of the Dow. Specifically, I want to start with Boeing. You want to find opportunity in the marketplace. This might be it. So one of the underlyings that just did not really fall much in this past week happened to be none other than Boeing. Just so we're clear, that's over a 1 year period. It's still up 100%. And the reason I'm bringing up Boeing, is Boeing has the single largest weighting in the Dow. So it has a weighting of about 8.8%. Goldman Sachs is next, okay, and on down the list over here. I just wanted to throw this, together to display it so that you realize you're like, all right, so where are you going with this? Boeing has the largest weighting in the Dow. And for the most part, if Boeing is going to make a large move to the downside, the Dow is nowhere near. It hasn't even scraped the surface of being damaged. And what kind of intimidates me is that, again, you have Boeing up still 12%. It's only dropped an extraordinarily minimal amount in the midst of some real sell-side activity. For every dollar, and this is just an estimate, for every dollar that Boeing falls, it would account for a 7-point move in the Dow. So when you take a look over at the chart and you back out to like, let's just go back to like a 1 year period of time, what price would you think, maybe Boeing could fall all the way back down to like 260. It would look like some of the other products out there. You realize if it fell down to 260, that's only getting Boeing back to where it was in November. However, coming back down to 260 is 70 points. Do some quick math over here. You're not going to have to be too high in the math, but that's a 70-point fall times 7 equals, that's 490 Dow points that could come out just because of Boeing. And I could go all day long. You should look at stocks. Again, what's big in the Dow? The Goldman Sachs, 3M, United Healthcare, Home Depot. A few of these stocks have barely, scraped the surface of even seeing any sell-side activity. Now, next thing I do want to talk about. Briefly, I want to look at XLU. Why? The XLU, it's fallen hard. I actually have been selling puts in the XLU. I want to own XLU, okay? Why? Well, number one, there's a dividend out there of about 4.2%. Okay. And again, I want to own the actual shares of the XLU, and I'm selling puts to do it. But if XLU falls back down to like, even the 46 level, you have to realize its dividend will be very close to 5%. And even in a rising interest rate environment, I'm sorry, a dividend of almost 5% is going to attract all the monkeys that are scared of the market. You think about this, okay? People are scared of jumping into the bonds right now because the bonds have been selling off. So what they're likely to do is look for something, well, like utilities. So I'm trying to get ahead of the street on this one and say, all right, utilities, they could have a little bit more downside, but the dividend is spectacular in them. So let's get there before all the funds realize that the marketplace might continue to fall. Again, sell puts or buy XLU. Coming down to the 45, 46 level doesn't really scare me all that much more. I want to own the XLU. That dividend near 5%. It's going to catch everybody's attention out there. Another one that's starting to become advantageous. Wow, did they beat up energy this week? That, people, is spectacular. Energy drops, but again, it's back where it was just a couple of weeks ago, right? You have to just put this in like context. However, even when you look at like a 5-year, that's still some good damage. I will be looking at XLE, and I'm going to nibble a little bit, but probably closer down to the 60 level. Again, down to the 60 level is when I'm really going to start to accumulate a couple of shares. And again, the XLE also has a dividend associated with it, less than 3%. It's neither here nor there. I'm going to sell some puts, and you can see I've already started to nibble on this. I'm going to sell a couple of puts to be able to get into the XLE. And last but not least, one thing I do want to cover for those of you that are trading, on kind of a day-to-day basis. And I'll tell you right now, one of the things you have to look at in the current marketplace, and I'm going to take off some of these expected moves. The bounces that we have seen this week, the bounces that we're likely to see, maybe Monday or Tuesday. Right as of right now, short the rips. Think about that for a second. Short the rips. We're going to see some wild moves up. One thing that is a hallmark sign, just an absolute hallmark sign of volatility, are the most explosive moves to the upside that you've ever seen. It wouldn't surprise me to see the S&Ps back to 2750. Okay, what you have to get in your mind at this point in time is, okay, this is not a buy the dip kind of situation. The reason the market is going to rip is they are covering the shorts, reload, push. Okay, for right now, forget everything that you saw over the last couple of years regarding a buy the dip or anything of the kind. You cracked volatility wide open. You took out a couple of major volatility players in the marketplace. Okay, Pandora is out of the box right now. Short the rips. Give it some time. Okay, some of the up moves can be wild. You will never time the rips perfectly. Use defined risk spreads. Short the rips, because you're not going to be disappointed at some of the downward momentum you will get until this volatility subsides. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.